All right, this is exercise 8-10A, and I'm going to go a little beyond what the book does, but to demonstrate the different methods of applying these different depreciation allocation systems. All right, so the double declining balance system takes a lot of depreciation up front, so it's an accelerated depreciation system. The units of production depreciation tries to apply the depreciation basically as an asset is actually used up. Straight line depreciation just assumes you're going to use it up evenly throughout the lifetime. All right, so this photo service bought a new printer for $38,000. It's expected to have a 4-year useful life and a $3,500 salvage value. And they have some expected printing stuff as they go along. They're forecasting 1.5 million pages, but they also give you the actual. Notice they took more than 1.5 million images. What happens with these depreciation systems is if you get to the point where you're taking, you don't depreciate below the salvage value anyway. So with this particular instance, since the cumulative in those 4 years goes beyond 1.5 million, then you'd have to reduce that last year depreciation so that it's only 280,000. So the grand total adds up to the 1.5 million pages. Okay, so how do you know how many pages you're going to actually take? You don't. You're making an educated guess. All right, so with any of these things that we're going to depreciate, we want to have some basics laid out. The cost minus the salvage is the depreciable base. Okay, so we need to also know the useful life, and that's 4 years for this particular asset. 38,000 minus 3,500 give you the depreciable base of 34,500. Okay, so if we are allocating these costs out using the units of production, what we have to do is we're going to depreciate a grand total of $34,500. For the units, the per unit depreciation then would be 1,500,000 divided by, sorry, got that backwards. The 34,500 divided by 1.5 million units is a little over 2 cents per sheet. Okay, so with this particular method, for year 1, 2, 3, and 4, for the units of production method, we would simply take the units times the cost. And the grand total of that's going to be $34,500. Remember, I made an adjustment for this last year already because the actual depreciation that they take can't go over the hypothetical unless they wanted to change in the middle, but let's not go there. So once you get to the 1.5 million units and you've taken the full depreciation, you don't go below the salvage value. All right, so this is under the units of production method. The double declining balance method is very complicated looking in the textbook, so we just won't screw with that. But there's an Excel function. Double declining balance, open parens, get the FX up there. If the cost is 38,000 and the salvage is 3,500 and the useful life is 4, then we can calculate per period and Excel will automatically cut back so that you don't depreciate more than the 34,500. So you haven't got to make the adjustment in there. And we would compare that to straight line depreciation. There's actually a function for that. The use is mostly the same inputs. 38,000 is the cost, 3,500 is the salvage, and the life is 4. So each year you take 8625, grand total of 34,500 in depreciation. If you let Excel do it for you, life will get a lot simpler. How this works, notice with the double declining balance, you take a lot of depreciation in the early years and not so much in the later years. The units of production, you take it basically as you use up the machine. Straight line, it's just a fixed number each period. So if we were going to graph this, it might show you a little bit better how the different methods might actually plot themselves out. Okay, so with the double declining balance method, a lot of depreciation in year 1, not so much in years 3 and 4. Straight line depreciation, the exact same amount in each of the periods. The units of production depends on whether you use it evenly through the year, but it would more closely track with your actual usage of the equipment. All right, and then the latter part of the question, the printer was actually sold at the end of year 4 for $16,500. What would happen with that is that if you took the book value, and the book value at the end of that period would be 3,500, and then the sale price was $1,650. It means that you sold it for less than the book value, so you would have a loss on the sale of $1,850. Essentially, you're just taking $1,850 of depreciation at the end of year 4, and so you would be able to write that off for your taxes, but you would just claim the last $1,850 of expenses right then and there. Of course, now if you had known you were going to sell it for $1,650, you could have just used that as a salvage value. The loss on sale is recorded as a reduction of the book value. You take the book value to 0 and then record the difference between the book value and the sale price as the loss.